Which retirement strategy could best support your dreams of financial independence? Is it dividend investing or the 4% rule? Well, both methods offer distinct paths to financial independence, yet the choice can feel overwhelming. Dividend investing provides steady income and long-term stability, while the 4% rule offers simplicity and full market participation. But which one aligns best with your goals and risk tolerance? And how do you compare in terms of volatility and generational wealth creation? Well, let's dive into it right away. When evaluating the decision between dividend investing and the 4% rule, it's crucial to understand the historical performance of the S&P 500. The S&P 500, a benchmark index composed of 500 of the largest publicly traded companies in the US, has shown remarkable growth over the decades. Since 1957, the index has been a reliable indicator of the overall performance of the US stock market. One of the critical aspects of this growth is the comparison between the increase in share prices and the growth of dividends paid out by these companies. Starting with share price growth, the S&P 500 has exhibited substantial appreciation since its inception. From 1957 to the present day, the share price of the S&P 500 has increased by approximately 11,000%. This impressive growth highlights the power of long-term investing in the stock market. Investors who have held onto their investments over these decades have seen significant wealth accumulation, driven primarily by the rising value in their shares. By contrast, the growth of dividends within the S&P 500 has been more modest but still noteworthy. Over the same period, dividends have grown by nearly 4,000%. While this figure is less than the share price growth, it underscores the consistent income stream that dividends can provide to investors. Dividends represent a portion of a company's profits distributed to shareholders, offering a tangible return on investment regardless of the fluctuations in share prices. When comparing these two growth metrics, it's clear that share price appreciation has outpaced dividend growth. However, focusing solely on share price growth can be misleading. Total return, which combines share price appreciation and dividends, provide a more comprehensive view of an investment's performance. For instance, even though dividend growth is slower, dividends contribute significantly to the overall return, especially during periods of market volatility when share prices may stagnate or decline. Market volatility plays a crucial role in how investors perceive and react to their investments. The S&P 500 has experienced numerous periods of volatility, with year-over-year fluctuations being a common occurrence. Historically, the index has been in the red about 30% of the time since 1957. This means that in roughly 20 out of the past 67 years, the S&P 500 has ended the year with a negative return. Such volatility can be emotionally taxing for investors, leading to anxiety and potentially irrational decision-making. However, the picture changes when we shift our focus to dividend growth. Dividends have proven to be more stable over time. Less than 10% of the years since 1957 has seen a decrease in dividends. This stability provides a buffer against market volatility, offering investors a consistent income stream even during downturns. This predictability can be a significant advantage for those relying on their investments for income, such as retirees. As you can see, dividend investing is an appealing strategy for those looking to retire early, but underlying the pros and cons can help you determine if this approach aligns with your financial goals and risk tolerance. One of the main benefits of dividend investing is the lower volatility in a dividend-focused retirement portfolio. Stocks that pay dividends usually demonstrate more stability than stocks that do not. Companies that pay dividends are often established, financially sound, and less likely to experience drastic fluctuations in stock price. And as we have mentioned, this stability can provide peace of mind, especially for retirees who rely on their investment income to cover living expenses. Dividend investing also offers the potential for creating generational wealth. Retirees can preserve and even grow their portfolios by focusing on investments that generate income rather than depleting principal. This approach allows for the possibility of passing on substantial estates to heirs. Instead of drawing down the investment, the principal remains intact, generating income that can support future generations. This long-term perspective can particularly appeal to those wishing to leave a financial legacy. However, dividend investing has its challenges. One notable drawback is the difficulty in planning around taxes. Dividend income can complicate tax planning, especially when dealing with different types of investments, such as covered call ETFs and REITs, which may be taxed differently. The unpredictability of dividend payments can make it harder to estimate annual income accurately, complicating efforts to qualify for certain tax benefits or subsidies, such as those provided under the Affordable Care Act. This unpredictability requires careful management and sometimes leads to unexpected tax liabilities. Another significant risk is the possibility of dividends being cut. Dividends are not guaranteed, and even well-established companies can reduce or eliminate their dividend payments in response to financial difficulties or changing business conditions. For example, companies like Walgreens, which had a strong dividend track record, have faced challenges that impacted their ability to maintain dividend payouts. This risk requires investors to closely monitor their investments and be ready to modify their strategy if needed. Furthermore, dividend investing often has limited upside potential in a bull market. While dividend-paying stocks provide stability, they may not experience the same rapid price appreciation as growth stocks during periods of strong market performance. This limitation means that dividend investors might miss out on significant gains when the market is booming. This conservative approach may seem less attractive for retirees who have long investment horizons or are willing to accept higher volatility for the potential of greater returns. The 4% rule is a popular strategy among those aiming to retire early, offering a straightforward guideline for withdrawing retirement funds. This method involves withdrawing 4% of your retirement portfolio annually, adjusted for inflation, to ensure your savings last throughout retirement. While this approach has benefits, it also has significant drawbacks that potential retirees should consider. One of the primary advantages of the 4% rule is easier tax planning. Retirees can better manage their tax liabilities with a clear, predictable withdrawal strategy. By knowing how much they will withdraw each year, they can plan for taxes more effectively and take advantage of tax-efficient strategies. For example, retirees can balance their withdrawals between taxable, tax-deferred, and tax-free accounts to optimize their tax situations. This predictability simplifies the tax planning process, making avoiding unexpected tax bills easier and ensuring they remain within their desired tax brackets. Another benefit of the 4% rule is full participation in market growth. Retirees can take advantage of the market's overall growth by holding a diversified portfolio encompassing various assets. This strategy enables them to profit from the stock market's long-term upward trend. Unlike dividend investing, which may focus on more conservative stocks, the 4% rule allows retirees to invest in growth-oriented assets, potentially leading to higher long-term returns. This full participation can be particularly advantageous during bull markets, where the portfolio's value can increase significantly. The 4% rule is also easier to plan overall. The simplicity of the rule makes it accessible and straightforward for many investors. By targeting a portfolio size that is 25 times their annual expenses, individuals can easily calculate their retirement needs. This clear target helps in setting savings goals and tracking progress over time. Additionally, the fixed withdrawal rate provides a consistent framework for managing retirement funds, reducing the complexity of financial planning and decision-making during retirement. However, the 4% rule is not without its cons. One of the most significant risks associated with this approach is the boom or bust lifestyle it can create. Because the strategy relies on withdrawing a fixed percentage of the portfolio, retirees are directly affected by market volatility. In bull markets, this can lead to substantial growth in the portfolio and a higher standard of living. However, in bear markets, retirees may need to reduce their withdrawals or cut back on expenses to avoid depleting their funds. This variability can be stressful and may require significant adjustments in spending habits, which can be challenging for those seeking stability in retirement. The uncertainty about leaving generational wealth is another con of the 4% rule. Since this approach involves drawing down the principal over time, there may be little left to pass on to heirs or charitable causes. For retirees who prioritize leaving a financial legacy, this can be a major drawback. The gradual depletion of the portfolio can limit the amount of wealth and can be transferred to future generations, which may be an important consideration for those who wish to support their family or contribute to philanthropic endeavors. So now, why choose dividend investing over the 4% rule? Now, as you may have noticed, there are many reasons why you should choose dividend investing over the 4% rule. One of the key reasons to choose dividend investing is the sense of control it provides over investment outcomes. Dividend investing focuses on choosing companies that regularly pay and increase their dividends. With this, investors can build a portfolio that generates a steady income stream, independent of stock market fluctuations. Focusing on dividend growth instead of timing share prices is another significant advantage. Dividend investors prioritize companies with a strong track record of increasing their dividend over time. This strategy shifts the emphasis from the often unpredictable task of buying low and selling high to accumulating a growing income stream. Dividend growth investing also capitalizes on the power of compounding, as reinvested dividends can purchase more shares, generating more dividends. This cycle can lead to substantial income growth over the years, providing a reliable source of funds that can outpace inflation and increase purchasing power. This focus on income stability and growth contrasts with the 4% rule, which relies on selling a portion of the portfolio yearly, subjecting investors to market risks and potential adverse timing. Creating generational wealth is another compelling reason to favor dividend investing. This strategy ensures that the principal investment remains largely intact while generating income, allowing investors to pass on a substantial portfolio to their heirs. Unlike the 4% rule, which gradually depletes the retirement portfolio, dividend investing aims to preserve and grow the original capital. This approach provides financial security for the investor and creates a legacy that can support future generations. The ability to leave a lasting financial foundation for family members is an important consideration for many, adding a meaningful dimension to the investment strategy. Dividend investing also mitigates a risk associated with the sequence of returns. Retirees following the 4% rule must contend with the potential of poor market performance early in retirement, which can drastically affect the longevity of their portfolio. In contrast, dividend investors are less impacted by market downturns, since they rely on the income generated from dividends rather than the need to sell shares. This income-focused strategy provides a buffer against market volatility, ensuring that essential expenses can be covered even during economic downturns. This resilience makes dividend investing particularly appealing for those who seek a stable and predictable retirement income. So, which strategy aligns with your financial goals? Comment below with your thoughts, and if you found this video helpful, please give it a thumbs up. Don't forget to subscribe and turn on the notification bell for more amazing videos.